Welcome to the Deep Dive. Today, we are strapping in for the Q3 2025 earnings conference call for a company at a real crossroads.
It really is. This is a fascinating one. We're looking at a major pivot inside a huge tech player where, this incredible future-facing growth is kind of masking some pretty historic weakness.
And our deep dive today is really to uncover that new core identity that's emerging from the noise.
Yeah, and you could tell this was a big one just from the timing. They held the call pre-market, 7:30 a.m. Eastern. That's usually a sign that management wants to grab the narrative on a complicated story.
Right, they want to get ahead of it.
Exactly. So our mission today is to break down how the market looked past this, truly massive headline loss, and decided to focus on the AI pivot instead.
Okay, so let's get right into that financial paradox, because the numbers, they're a bit of a head scratcher without the context.
We really are.
If you just look at the top line, revenue was RMB 31.2 billion. That's actually down 7% year over year.
Which is, not great.
Not great, but it did modestly beat the consensus estimates. So you start with a small win, but then you hit the big red button.
And that big red button is the GAAP loss. It's just enormous. We're talking a deleted GAAP loss of RMB 33.88 per ADS.
And just for anyone who might not know, ADS is the American Depositary Share. It's how you trade a company like this on the U.S. market.
Right. And that massive loss was driven by basically one thing, a non-cash impairment of RMB 16.2 billion.
Wow.
Yeah, which resulted in a final net loss of RMB 11.2 billion.
A non-cash impairment of 16.2 billion RMB. That is a serious, serious write-down. Before we go on, what does that actually mean? Why isn't that a total catastrophe?
It's a great question. Think of it like a strategic digital cleanup. Management looked at their old servers, their legacy infrastructure, the assets on the balance sheet, and just said,
this stuff is old.
This stuff is old and it's not efficient enough to power modern AI. So they declared it impaired. It hurts your accounting books now, but it's non-cash. No real money actually left the company this quarter. It just clears the slate.
So it's about positioning for the future, for more efficient investment in that next-gen computing power.
Exactly.
But isn't relying on the non-GAAP numbers, which just strip out this charge, isn't that a classic red flag? Why did the market just accept it?
Well, they accepted it because of the non-GAAP beat. This is where the real story is. The non-GAAP EPS, which is all about the day-to-day operational profit.
Right, ignoring the big one-time write-down.
Exactly. That came in at RMB 11.110 per ADS. The consensus was only expecting RMB 8.37.
Ah, so a significant beat.
A huge beat. The market saw that and said, okay, the old business is dying, but the new core is absolutely firing on all cylinders. They executed where it mattered.
And what's so interesting is how management used this quarter to formally lay out their new vision. They're calling it the AI native view.
And that's not just some marketing slogan. This is a formal resegmenting of the business to show everyone that this future revenue stream is already here and it's already substantial.
So this is the heart of the bull case then?
It absolutely is. These AI-powered businesses, all together, they generated about RMB 10 billion in revenue for the quarter. And they're growing at over 50% year over year.
Okay, so let's break down that 10 billion, because this AI native view has three main pillars, and they're all growing at pretty different rates.
Wildly different rates. The first pillar is the foundation, AI cloud infrastructure, or just infra. That hit RMB 4.2 billion, up 33% year over year.
Which is solid.
Very solid. But if you drill down into that, the subscription-based AI accelerator revenue, so the really high-performance computing.
The stuff you need for the big models.
Exactly. That part grew 128% year over year. That shift to subscriptions is a massive positive for margins.
And for visibility. Investors love that. Okay, pillar number 2 is AI applications. That brought in RMB 2.6 billion.
Right. And these are real-world products. We're talking about things like their digital employee offerings. They even mentioned the Daniel Wu English coach.
Which is what, like a hyper-realistic AI tutor?
Pretty much. An AI to train business professionals. And then you have the enterprise stuff like the FM agent, which they're using for logistics, energy grids, even port operations.
So tangible products that are generating revenue.
Yes. And then you get to pillar 3, which you called the exploder, AI native marketing services.
This number is just, it's wild.
It's staggering. It delivered RMB 2.8 billion, but the growth was 262% year over year.
262%.
This is where AI agents and digital humans are being used directly in live streaming and e-commerce. And the key thing here is the mix. This segment is now 18% of their core online marketing revenue.
And what was it a year ago?
just 4%. So that shift is radical, and it's happening incredibly fast.
And it needs to, because if you contrast that with the legacy business,
Right.
it really explains why the overall top line looks so weak. The old school online marketing revenue, the search ads, that declined 18% year over year.
To RMB 15.3 billion.
Right.
And management themselves called it a record revenue decline for that segment.
So it's a pure tale of two companies, one shrinking fast, one growing exponentially.
That's the whole story.
So how do you outrun that drag? You have to scale the new stuff fast. Let's talk about the two biggest catalysts, starting with mobility. Apollo Go seems to be hitting its stride.
The numbers are eye-opening. In Q3 alone, Apollo Go delivered over 3 million fully driverless rides.
3 million.
And that's a 212% year-over-year surge. It's accelerating. Last quarter, that growth was 148%. So the curve is getting steeper.
And it looks like they're really pushing the global validation, which is so key for investor confidence.
Absolutely. They're in 22 cities now, up from 16. And look where they're going. They got a commercial permit in Abu Dhabi.
Which proves it can handle really harsh conditions.
Exactly. And then a partnership in Switzerland, which signals they can handle the toughest regulatory environments in Europe. This is about proving operational maturity.
So beyond mobility, you have the other engine, product innovation, with ERNIE 5.0.
Right, which they unveiled just before the call. They're positioning it as the first native omni-modal foundation model.
And management really stressed this application-driven approach.
They did.
But that sounds like, great management speak. Every AI company says they're application-driven. Do we have any proof that ERNIE 5.0 is actually better in the real world?
Well, according to them, the proof is in the data from those FM agents and digital humans we talked about. They're saying the development was driven by feedback loops. If a digital human wasn't making sales in a live stream.
They tweak the underlying model, not just the avatar.
Precisely. They said the model's value comes from delivering measurable business results, not just from scoring high on some synthetic benchmark test.
Okay, so let's circle back to that big cleanup. The RMB 16.2 billion impairment, they were clear as proactive. They also said Q3 represents a lower point for margins.
And that's a really important signal to investors. First, it says this huge write-down hopefully won't happen again. And second, it means future spending will be on highly efficient AI gear, which should lead to better margins down the road.
Speaking of the future, there was a noticeable lack of guidance for Q4. No hard numbers, which seems pretty cautious.
It is, especially with the ad business is still under pressure. But the qualitative guidance was strong. They said they expect AI cloud and the AI native stuff to keep growing above the industry average.
And that's what investors are clinging to.
That's the whole thesis. They're pointing you towards the growth engine, not the slow legacy ship.
And all of this is backed by just a shocking amount of cash. The balance sheet is incredible.
It's a fortress. Nearly RMB 300 billion in cash and investments. That's about, 41.6 billion US dollars? It's a gigantic buffer.
And they're finally starting to talk about giving some of that back.
That was a huge takeaway from the call. They basically said the cash pile is too big. They explicitly mentioned reviewing buybacks and, quote, actively exploring diversified return mechanisms. For example, setting a dividend policy potentially.
When a company with over $40 billion in cash uses the words dividend policy, you listen.
You definitely listen.
So let's tie this all together. The core investor thesis really just boils down to a race, right?
It's a race. It's how quickly that AI-powered revenue, which is now about a third of the core business, can grow to surpass that 50% mark and finally stabilize the whole company.
The market's reaction suggests they're betting that the AI acceleration can win that race.
It does. They seem willing to look past the messy financials for a few more quarters.
Okay, that brings us to our not financial advice segment, where we pitch an outrageous but plausible trade idea based on the juiciest details from the call.
And this one is all about that massive cash pile, that nearly RMB 300 billion and all that chatter about shareholder returns. The market is still a bit skeptical here.
Right, because of macro risks, concerns about how they'll actually use that capital.
Exactly. So the stock hasn't been aggressively re-rated yet.
So what's the pitch? How do you catalyze that?
The trade idea is a long position, but it's contingent on them announcing a substantial one-time special dividend, or maybe a massive accelerated share repurchase, an ASR.
So you're not just waiting for the AI business to grow.
No, because that could take years to really force a re-rating.
Yeah.
I'm saying you use the cash, deploy, say, 10 or 15% of that RMB 300 billion pile in one big move.
And the argument is that a huge cash return would force a valuation adjustment almost overnight.
Precisely. It de-risks the balance sheet in the eyes of shareholders, it rewards them for their patience, and it forces the market to reevaluate the core valuation much faster. It tells the street this cash is an active tool for creating value right now.
A compelling idea. Using the cash buffer as a direct catalyst instead of just a safety blanket. That's our outrageous but plausible trade for this week.
So, to wrap up Q3 2025, it was a quarter of contrasts. A huge GAAP loss from an impairment was completely overshadowed by a big non-GAAP beat.
And that beat was fueled by that accelerating high margin growth from the new AI native businesses. The focus is now squarely on that strategic transition.
They're making the right moves, even if it causes some short-term pain on the income statement.
Absolutely. But here's the provocative thought for you to take with you. Which of these AI applications is the bigger deal over the next 2 years? Is it autonomous mobility with Apollo Go scaling globally?
Or is it the AI native marketing, with those digital humans and agents growing at 262%? Which one will deliver higher revenue and better margins?
You have to consider the operational leverage, the total addressable market for each.
That's the debate that will define this stock's valuation going forward.
We'll catch you next time for The Deep Dive.